The biggest bone of contention in the Indian taxation system today is indirect transfer of shares. Last year, the law got amended wherein indirect transfer of Indian shares came within the ambit of taxation in India. However, the amendment in law led to several controversies. The first controversy was that when you look at taxation of Indian shares or Indian assets pursuant to a global deal, what is the proportion which is relevant for the taxation to trigger? What is the definition of substantial assets in India? Is it 50%, 20%, 10%? The trigger point is only if substantial value comes from India. But what is not clear at this point of time is what is substantial, 50%, 20% or 10%. The Shom Committee report has given its recommendation on the definition of substantial. It actually goes ahead and says that if 50% or more values derived from India, then the indirect transfer rules get triggered. Now, whether these recommendations get accepted in the budget or not is something which we'll wait and watch, and that will have an impact on all global transactions which have Indians' shares as their assets. The biggest controversy surrounding this amendment is as to whether this is applicable to every transfer. Like, for example, is it applicable to transfer of one share? Is it applicable to 10% shares of the foreign company? Is it applicable to every stock exchange deal which happens? Or is it applicable only when the control shifts overseas? At present, the way law reads today is that it is applicable to each and every transfer provided the value substantial asset is located in India. This can lead to ridiculous interpretations because this would mean that every single transfer of shares overseas, irrespective of whether control is passed or not, irrespective whether it is substantial or not, leads to a trigger point in India. So it will be interesting to know as to how they carve out exemptions for listed companies, stock exchange trades overseas, or do they have a threshold for taxation? Is it that everything is taxed or only controlled transfer is taxed? It's very interesting to know how this thing will pan out. The third most important event to be watched is that whether retrospectivity of the amendment will continue. Presently, the law is retrospective to 1961. Whether it will be only prospective of whether the government will continue with the retrospective amendment is something which one has to wait and watch as to how this thing pans out. And the fourth thing is that how will they execute this? How will they go out and chase people to collect their taxes? Especially there are so many global deals happening. And how will they have a machinery to track these global deals and see how the taxes arising on these global deals because of indirect transfers happening in India is taxed? The second most important controversy in international taxation today is what is the rate of taxation applicable for a sale of shares by a non-resident of shares in an Indian company. Last year, the law got amended to provide for a concessional rate of tax of 10%. When a non-resident sells shares of an Indian company, which leads to a trigger of capital gains tax, then the rate applicable is 10%. The big controversy today is that is this 10% rate applicable to all companies or is it applicable to private companies as well as public companies? The technical interpretation of the law is that this is applicable only to public company. It is going to be interesting to see that why an equitable treatment should not be given to private companies too. Hopefully a clarification in law should come wherein both private as well as public companies get covered at the 10% concessional rate of taxation. It's going to be interesting to see if this amendment takes care of both private and public companies, and this will boost private equity investments into private companies also, which is the need of the hour. This is applicable mostly to countries where treaties do not exist. Suppose if you were not investing through Mauritius or investing through some other country where proper taxation rates are applicable like UK or US, then this 10% rate can be a big beneficial rate for investments into the country. Thank you very much.